Hey guys, it's Matt. And today I wanted to talk to you with a conversation with our CPA, Jason Dubnick. How you doing, Jason?
Very good.
So we wanted to share the conversation Jason and I we're just having our semi-annual meeting, about halfway through the year. So we're going to review some of our income and expenses and stuff and see how we're looking from a tax perspective. And we're literally just sitting here having a conversation like, you know what, this is so important, we need to share it with our folks on YouTube. And we've been using Jason for several years now, and we've been through several accountants in our 11 years in business now. And I've never been happier with a CPA than I have with Jason. What we were looking for when we were looking for another CPA was somebody who understood investing. Not all CPAs understand real estate investing, and who also perhaps owns some rental real estate themselves. Jason does both. And it just has been a great relationship, and he has saved us a ton of money that we would have had to pay out throughout. He actually audited our tax returns that other CPAs had done, and we got a check back when we first started working with Jason from other years, from I think our 2010, 2011 returns. We got a check back immediately when we started working with Jason, so I can't thank you enough for all the work that you've done. But I wanted to share with our audience the conversation that we had, because we're starting to see, as the DeRosa's group and as our property management company and as our fix and flip company gets more complex and grows, we're seeing more and more revenue. And the conversation you and I have was about how to shelter that revenue through different vehicles. So tell our audience a little bit more, if you can, just regurgitate that conversation. Sure. And we can play it out here again.
All right, thank you, Matt.
Sure.
So the topic that we discussed just now was utilizing an S corporation in your real estate portfolio, basically. And the idea behind where the S corp comes into play is that when you're involved in certain types of real estate investing, there's basically two main branches. There's going to be the passive real estate ownership and rental side, and then there's going to be pretty much everything else, which includes fix and flips, wholesaling properties, pretty much anything where your intent is really not to hold a property long term and for capital appreciation. And those two options are taxed differently. The rental real estate side, you can really get away with just using an LLC because it really is made from a tax standpoint. It's already very tax advantageous to own and rent properties. It's considered passive income, and you're not paying any payroll taxes on that type of income. When you get into the other types of investing, fixing and flipping, wholesaling, anything else like that, you potentially now have to deal with payroll taxes, and that significantly increases your tax exposure when you're calculating all your properties and you're calculating the potential gains you have to work through and analyzing the property.
Point of clarification on that: payroll taxes are, like, if I was an employee, correct, I would pay half of that at 7.5%, and it would show up as what on my W-2?
Social Security and Medicare tax.
Got it. Okay. So some folks don't know that if you're an employer, the employer has to pay the other half of that. So employer pays 7.5% towards Social Security and Medicare on behalf of the employee. But because if I am self-employed and I'm generating revenue through fix and flips or through wholesales or whatever it is, right, I'm the employer and I'm the employee. Correct. So I pay 15% of my revenue that I generate if I don't use the proper vehicles like S corp. So first of all, S corp, it's pretty much an LLC. It's just an LLC. It's just filed differently with the IRS, right?
That's correct. It's simply just a tax designation. It's not a separate legal entity. So if you already have an LLC, that would be a good candidate to become an S corp. It's actually a very simple process of just simply filing an election with the IRS, and you become an S corporation. So you don't have to dissolve your entity. You don't have to close bank accounts. It's actually a very easy transition.
Okay. But I still need to have some sort of, the way I understand it from you is the way that you structure this, or the way that you've advised me to structure it, we have revenue through our property management company. That's not passive income through the revenue we make through property management. We also do fix and flips. Mm-hmm. We don't do too many wholesales, but that would be a candidate for it as well. Sure. And we're also taking acquisition fees for the purchase of large apartment complexes and things like that. So that would all be taxed as ordinary income if I didn't use an S corp, correct?
That's correct. That's correct. Any type of earned income is really a great candidate to run through an S corporation. And ideally, like as we said, we're talking about that savings of the payroll taxes. Any of those other entities where any of those types of activities that you're running through any other type of an entity or running through an individual's name, really having to pay that extra payroll tax, you're almost talking about potentially doubling your tax consequences, and it absolutely does. But creating this entity, and the nice thing is that for an investor who really does kind of have his hands in different types of these strategies, you really can get away with having one S corporation kind of as the umbrella for your entire investment portfolio. It's
brilliant.
It's a great strategy to have. It's a significant tax savings, and the nice part is that the higher the income, the more the savings.
Yeah.
So,
and the way you've explained it to me is it's not something that's straight for for our audience. If you're just getting started in real estate investing and haven't done a deal yet, and you want to start doing fix and flips or wholesales or whatever it is, S corps are probably not the first move to make. This is more of like a move to make for like phase 2 once you've got some revenue coming in and everything like that, right?
That's correct. It's really not made for when your business is still starting out. You may be expecting to have a loss for the first year or so, or maybe more of a break even. It's really made for when the income starts coming in. There is a break even point that you want to run a calculation on. But the beauty is that the S corp can be filed retroactively. So even if it's January or July, and you're just buying your property, or you're getting involved in some projects, and you're not quite sure how much money you'll make, but it's December, and now you do realize you have more profit than you expected, you can actually still file retroactively to become an S corporation for that year. So it's actually a very unique strategy that you can implement after the money's there, and you will have the savings. And if not, worst case is you just become an S corp effective the next tax year. So you may lose a year, but there is still an option to go backwards.
And the way that you've explained it to me, just to view it like super layman's terms, is that I am still an employee of the S corp. So S corps need to pay payroll and have like a salary to me as the owner that's taxed as a W-2, right? So I'm an employee of the S corp. So I have a fix and flip company or a wholesaling company, one of the two. The company generates $100,000 in revenue and wholesale fees and fix and flip profit and everything like that. I pay myself $30K on above the line payroll through payroll company like Paychex or ADP or something like that, right? That additional $70K is business income.
That's correct. That's correct. So exactly like your point said, is that if you're operating as an LLC, in your exact example, and you have $100,000 of profit available for you at the end of the year, that $100,000 is subject to both income taxes and payroll taxes.
Yep.
We're not going to factor in the income taxes right now because those don't change between the S corp or the LLC, but it's really those payroll taxes that we're focusing on.
15%.
15%. So on $100,000, we're talking about $15,000 in payroll taxes.
Yep.
Now, if you were to convert this over to an S corporation, in your exact example, the IRS simply requires that you draw a reasonable salary. Now, obviously, there's you may have to have a few conversations and figure out what is reasonable. You don't want to undercompensate yourself, but certainly you save the most when you don't take more than you need to either. There are some additional costs that come in with the S corp, but the break even is actually very, very low. So, Matt, in your example, if you were to take a $30,000 W-2 payroll, again, there is no change on the income tax side. But that $70,000 that's remaining at the end of the year after you took your $30,000 salary is no longer subject to payroll taxes. So on $70,000 at 15%, you just saved yourself over $10,000 in payroll taxes.
Yeah.
Now there will be, figure maybe another $1,000 or $2 in administrative costs of running the S corp, but you can see in that situation it just paid for itself many times over, and that's just the first year.
Yeah.
And again, the higher the income the following year, the savings continues to just go up exponentially.
So this is great. Again, it's not a first move for the folks that are just getting started. This is something to kind of earmark and get back to once you're established. But for those of you that have been in business for a while and either have an established real estate business, or we've also talked to folks that have other kinds of businesses that are their primary source of income, and they're also doing some passive investments in real estate. I found that S corps have been a great benefit. Have saved us quite a bit of money, as Jason just outlined here. So, Jason, if folks want to reach you, how do they get a hold of you?
Sure. They can go to the website, which is www.dubnikcpa.com.
And it's DUBNIK.
CPA.com. And all the information's on there to reach myself, reach my partners, and happy to help.
And are you're in New Jersey, but you could work in all 50 states?
That's correct. Our office is located in Freehold, New Jersey, but we can handle tax returns anywhere in the country.
Anywhere in the country.
So.
Cool. All right, great.
All
Jason,
right.
thank you.
No
Great
problem.
conversation, guys. Thanks for watching.